What's up, my fellow wealth creators? Matty Ice here. I want to break down an article that a friend of mine sent me the other day, and it's really, really sad and just extremely frustrating to me as a professional in this industry, licensed here in Florida. And, this is like the article we're going to break down. This is one of the main reasons I started my channel, is to educate people about the risks of some of these products. And I think the biggest issue is that so many people have no idea what they're actually buying and how to manage these things. We're going to be talking about how this 72-year-old woman paid premiums into a universal life policy for decades. I think it was, since 1987. And the policy is being terminated. It's lapsing because the cost of insurance has become too expensive. It's eaten all of her cash value. She either has to make a massive payment in order to keep it in force, or it's gone. So that pretty much means she paid premiums for decades and basically just gave money to the life insurance company and has nothing to show for it. That is one of the major risks of these universal life products. And I don't care if it's regular universal life, variable universal life, or indexed universal life. That's the really popular one right now. They're all built on the same broken chassis. It's annual renewable term. All right, I'm gonna break down what happens with this policy, and this is not uncommon, guys. Like, these policies are just blowing up. If you haven't read the book by Elon Moaz, Lapsed, you can get it on Amazon. I'll put a link down in the description, just to give you easy access to it. Get the hardcover or the paperback, because there's a lot of numbers and charts. But he breaks down in that book why these products just don't work. A lot of the time. I'm not saying they can't ever work. If you, like an IUL, if you max fund it and you manage it properly, things like that, can it work? Sure. But the analogy I use is, can Biden put two coherent sentences together? Every once in a while, sure. Can he find his way off the stage by himself? Every once in a while, sure. I'm not going to bet my hard-earned money on it, though. No, thank you. Not interested. So can they work? Sure. It just depends on how much risk you want to take. How much do you want to roll the dice with your retirement income? All right. So anyways, I want to break down this article. I want to share it really quick. It's funny too, because when he shared this article with me, we were actually going back and forth about infinite banking, whole life insurance, and things like that. And he's not a fan, which that's fine. It doesn't bother me. It's definitely not for everybody. But then he shared this article. He's like, this is why I don't like life insurance. And I said, like, well, I don't like this either. This is terrible. It's not even what we're talking about. And that's why when I hear agents compare IUL and whole life, there is no comparison. It's apples and tater tots, guys. They're not even close to the same product. So you just you can't use this to bash whole life, which is one of the things. I'm not going to say he was trying to do that, but this is why. One, I'm a huge proponent of max funded, dividend paying whole life insurance, because this stuff doesn't happen with whole life. It just doesn't, unless you massively over leverage the policy and you're just an idiot with it. Yeah, then a whole life policy can lapse. But even if a whole life policy is not structured properly, which any universal life product must be structured properly, otherwise it's almost guaranteed to lapse. But even if a whole life policy is not structured properly, it will still be okay in the long run. The death benefit will be there. You don't have to make premium payments your entire life. It's not going to lapse because of that. So anyways, let's break this down. I'm going to link the full article down below too, if you guys want to go through it. I'm just going to go through a few points here. But I guess that, there was a video on TikTok going through this situation. I think this person is an agent. And she had a conversation with this woman, 72-year-old woman, left upset and broken after paying into her life insurance policy for 36 years, only to get a notice that it will soon terminate and pay out nothing. That just breaks my heart. I can't even imagine being 72 years old, 75 years old, 80 years old, whenever it happens. And you've been putting money into this thing the whole time, expecting a certain outcome, expecting it to be there, to have your cash value, have the living benefits, have the death benefit to pass on to cover memorial expenses, pass on a legacy, maybe create some tax-free retirement income. It's one of the big promises of IUL, is how you can create all this tax-free retirement income. I saw somebody post the other day that you can get over $100,000 for life inside of an IUL. You build up all this cash value. You can take out 8 to 10% every single year for life. It's a lie. It's borderline a lie. It's a half truth. It's based on ridiculous numbers. And I can't imagine expecting all of these things to be there for you when you need them the most. But by the time people find out that these policies are blowing up, it's too late. They get the letter in the mail for a massive bill in order to keep it in force, and they can't afford it. At 72 years old, do you want to pay thousands of dollars all of a sudden to keep your policy in force? I thought it was just going to be in force forever. I thought it was permanent life insurance, right? I don't even think anything built on annual renewable terms should be allowed to be called permanent life insurance, because there's nothing permanent about something that can lapse due to rising cost of insurance. Like it's really misleading. So let's see. She got the letter in the mail from the life insurance company that if you don't pay X amount, whatever it was, it's going to terminate in February 2025. And she's been paying premiums since 1987. So even while still paying all the premiums. And I'm not sure if she was taking income. It doesn't sound like it. I imagine they would have put that in the article if this lady was taking income from the policy. She wasn't even taking income, which injects even more risk into the policy later on down the road. She was making her premium payments, and the cost of insurance still ate up all of her cash value and completely destroyed her policy. That's just crazy. Now, right here it breaks down. The article breaks down like what universal life insurance. I'm not going to go into. I'm not going to go like break down too much more of the article. You guys can read the whole thing here. But there are a few things that I wanted to cover personally about this and just have a conversation about what universal life is. Universal life insurance, particularly IUL, indexed universal life, because that's primarily what is sold these days. The problem is it's built on the same broken chassis as universal life insurance. That's why this policy blew up. It's called annual renewable term, guys. It's one of the most important things. You need to know it first. If you're looking into these types of policies, know that it's built on annual renewable term. What does that mean? Okay, well, really all you need to know about it is that term insurance gets more expensive every single year. Your cost of insurance goes up eternally every single year, because the older you get, the more risk you have of passing away, right? So the costs are factored in for that, for the life insurance company. Okay. Now, with something like a universal life policy, where, I mean, here's the thing, back in the 80s, and it was probably not funded properly either. You probably didn't max fund it, which you have to do with these policies. Otherwise, you really run the risk of the cost of insurance eating away at your policy. So she probably didn't max fund it. Also, back in the 80s, when the interest rates were really high, these policies illustrated really good, 8%, 10%, 12%, whatever it was, for the life of the policy. And then what happened? Interest rates were crushed. I mean, they were zero. They cut them down to zero in 2020. I think down to 1% in 2008, whatever. So if you were illustrated at, let's say, 8%, you're going to earn 8% on this financial product as long as you make the premium payments. And all of a sudden, it's only earning 1, 2, 3, 4, probably more like 4, but it's like been cut in half. What do you think that is going to do to the outcome that you were expecting? It's going to destroy it, and it significantly increases the possibility of the policy lapsing due to cost of insurance. But here's the thing, even if it doesn't lapse, let's say by some miracle, your policy makes it through and it stabilizes, and it's the cost of insurance is not completely eating away at your cash value. Like in an index universal life policy, you can manage the net amount of risk. I suppose you can do it too with a universal life policy. But what you're charged on your cost of insurance is based on what's called the net amount at risk. All right, you guys have to know the difference between cost of insurance and net amount at risk if you're considering one of these products. But let's say by some miracle your policy makes it to your 85, 90 years old, etc. All right, and you manage it properly. But now you don't have anywhere near the amount of income that you were. I'm not going to say promised, because I don't think anybody actually promises anything, but when you're looking at that illustration, they're showing you can get $100,000 every year starting at age 65 for the rest of your life. And you're making plans. You are making decisions based on that illustration, which is not going to happen. What happens when you don't have that income stream anymore? When you don't have that death benefit anymore? When you don't have the living benefits anymore? The cash value is destroyed. Like, you were relying on that product to be there for specific reasons, right? And now it's gone. So what are you going to do? What's your backup plan when that doesn't happen? Even if it doesn't lapse. Okay, so you still have the policy. Congratulations. But it's not anywhere near what you were expecting it to be. That is a massive problem. It's something you need to plan for. Now, here's the other thing. Just to finish that point, guys, your cost of insurance in these products, any type of universal life product, whether it's regular UL, VUL, GUL, IUL, anything built on annual renewable term. Okay. Your cost of insurance goes up every single year, exponentially as you get older. Okay. And if you don't manage these policies correctly, if it doesn't perform as illustrated, that cost of insurance is going to destroy your policy. Okay. So you need to know the difference between cost of insurance, net amount at risk. That's really important. The other thing that I want to bring up here that I think is a massive issue with these types of policies, IULs, UL, I don't care which one it is that a lot of the times agents don't stay in the business. And so nobody's doing an annual review with their clients about how the policy is performing. Like, guys, these policies need to be actively managed. You have to review them at least once a year with an in-force illustration with a licensed professional so that you can get an idea of how this thing is performing and what it will look like in the future based on what it's done so far. And because here's the thing is, if this lady was doing that, she would have known a long time ago that there's a problem with this policy, and she could have adjusted her strategy accordingly. She could have done something about it. Maybe she did a 1035 exchange into a whole life policy. Maybe she did a life settlement. So there's options that people have. But if it's too late, if you wait till it's too late, now you can't do anything. The policy's blowing up and you have to pay thousands of dollars in order to keep it in force. That's the worst case scenario. And now the life insurance company has all of your premium payments over however long, and it is no longer on the hook for the death benefit. That's a massive win for them. We don't want to do that. You have to manage these policies, guys. You have to do an annual review. And it's really frustrating to me that not that agents don't stay in the business. I mean, things change. I get that. But I don't know. It seems to me like these life insurance companies especially with these types of policies where this is a very real possibility and a very common occurrence with these policies, is they need to take more responsibility to make sure that someone from the company is reaching out to these policyholders to do an in-force illustration every once in a while and to do a review of the policy so that this doesn't happen. It's just because it could have been easily avoided. There's something called the cash value rainbow. It's something that Elon Musk talks about in his book, Lapse. I highly recommend it. If you're considering one of these products, you have to read that book first and then make a decision. Okay. But he calls it the cash value rainbow. And the cash value in the beginning years of these policies is fine. Like, we don't really have to worry about cost of insurance. It's pretty low, because when you're younger, your risk of dying is a lot lower, obviously. So your cost of insurance can be a lot lower. So your cash value grows really good. But as you start to get older and that cost of insurance gets more expensive, that's when it slows down, starts to curve over. And then you reach that tipping point where the cost of insurance, the growth of the policy is no longer covering the cost of insurance. And now there's more cost of insurance than the crediting that you're getting in the policy. So where does that come from? They take it from the cash value, and all of a sudden your cash value goes like this. He calls it the cash value rainbow. Is really, I thought it was a really good description of the situation, because that's exactly what happened. Her policy probably, did really well in the first couple of decades, maybe first decade, first 10, 15 years. But then as she got older, cost of insurance goes up, not to mention the interest rates plummeted as well. So she's not earning the 8 to 10% anymore. She's earning 3 or 4%. You combine all those things, this is what happens, guys. It completely blows up in your face. And I don't even think she was taking income. You start taking income on these things while this is happening, you're really rolling the dice, The other thing I want to mention too, just got some notes over here, bullet points I wanted to cover. The other benefit that is promoted with these policies is flexibility. Okay. Now, when you hear something like a financial product being flexible, Like you have some flexibility, you can control your premiums, you can control your death benefit. And, if you can't afford to make a premium payment, no problem. You can skip it, whatever. The policy will fund itself, etc. That comes with a lot of risk, especially in these products. Not so much with whole life, because again, you have guarantees in whole life products. Okay. That's a whole other conversation though. The flexibility can really, really work against you because what happens is the flexibility with, for example, the premium payment. If you don't fund these policies enough, every time you do that, it increases the risk of the policy lapsing or getting into a lot of trouble. They have to be funded properly. So yeah, you might be able to skip payments here and there, but is that really what you should be doing? You got to be really careful, because if you have to skip payments, you probably shouldn't have set the policy up anyways, or at least not in the way that you did. It probably should have been structured differently. You don't want to be exercising that flexibility benefit in these policies, at least very often, because it injects even more risk into the policy. You have to be really careful with that. All right. Life doesn't happen on an illustration, guys. This is one of my favorite quotes from one of my mentors, Chris Kirkpatrick. And it's 100% true. Like I can't tell you, like the illustrations I've seen for IUL, that's really what I focus on, is just insane. It's like the illustration is just crazy because it's showing growth in the policy every single year based on the performance of a stock market index and the cost of call options. Like, you're not going to get 6 to 7% every single year in a product that is based on the performance of the stock market. Now, it's not invested directly in the market, no, but you're going to have 0 years. And when you have those 0 years, you still have cost of insurance, you have fees, you have, not to mention you didn't get the credits that you're supposed to get that year. So what happens to the numbers in that illustration at that point? It's again, you got to be aware of these things. Like these things illustrate like a CD product, but it's based on the stock market performance, guys. Like, how does that make sense? You're going to show me growth every single year, and you're going to show positive arbitrage as well when I start taking income. Like, oh man, there's so many red flags with this product. Now, again, can it work? Sure. You set it up properly, you manage it properly. You guys want to roll the dice with your hard-earned money on that? Be my guest, as long as you know what you're getting yourself into. All right. Even on whole life policies, I say the same thing. It's an illustration, but it's a lot more likely to happen because these companies, because it's dividend paying whole life insurance, these companies have never missed a dividend payment. So when I look at an illustration showing that dividend every single year, I'm pretty confident it's going to happen. Could it not? A couple of years? Sure. But I'm okay with that. Even if that were to happen, the policy is still guaranteed to grow every single year, and it's not going to lapse. Again, unless I completely over leverage the policy, take out way too many policy loans, and I don't pay them back, sure, I can get into trouble with that. But I don't have to worry about the rising cost of insurance, eating away at my cash value. Like, it's just, the risk isn't there. And I sleep pretty good at night knowing that, and I'm not willing to roll the dice for an extra 1 or 2 percentage points of potential growth. That's probably not going to happen anyways. Like, it just doesn't make any sense. Not to mention with IUL, guys, the other big promise with IUL is that you can get upside potential, downside protection in the market. You can do that with a whole life product. Okay. If you want to learn more about that, I have a link in the description to another training I did. Of course, you can book a call. We can have a conversation about it, but you can get the same upside potential, downside protection, or very similar in the market without all the problems of IUL. Okay. I guess the last thing I would ask you, I've kind of alluded to this already, but just to finish my rant here, is like a question that was put to me when I was starting to go down this rabbit hole is, if you're about to get on a flight and there was a 5% chance of that plane crashing, would you get on? No. Of course not. Even though there's a 95% chance that it might that you'll get to your destination. What if there's a 5% chance that plane's going to go down? I'm not getting on that plane. So if there's a 5% chance that your IUL is going to blow up in your face in retirement, why would you take that chance? What if it was 10%, 20%? I mean, we really don't know what those percentages are, other than to understand, like, once you understand how these products actually work, the mechanics of it, and the actual risks involved. Most people, at least I did, I ran the other direction. I wanted nothing to do with it. I almost bought an IUL based on those amazing promises of upside potential, downside protection. You can't lose money in an IUL. You get all this tax-free retirement income. I had one guy show me income for $212,000 per year, starting at age 65 for life. And of course, that illustration did not show any down years whatsoever, even though it's based on the stock market. Really? I mean, are we really rolling the dice with our money on crap like that? I'm not. I can't do it, guys. So anyways, I wanted to share this with you because this is a real life example of the issues that could really that can really come up with these policies. And yeah, I can already see the comments from IUL agents, like, oh, you got to max fund it, you got to structure it properly, blah, blah, blah. Look, I get that. And look, as long as people understand exactly what they're doing and what they're putting their money into, who am I to tell them not to buy an IUL? I would never buy an IUL because it's a faulty product, in my opinion, and there's no point to it. You can get upside potential, downside protection in a whole life product, but you have to, at the bare minimum, guys. Like, if you are going to consider these products, please, please, please make sure you understand how it works. It is structured properly, and you manage it. You do your annual review every single year. Look at, and here's the other, I'm going to finish up with this. Don't look at interest credited. Look at the growth of the cash value, because a lot of the times that's different. It's very different. It'll show crediting of 6%, 7%. Here's the interest you earned. What's the net, though? What did your cash value actually grow by? It's really important. You got to look at that stuff, right? So anyways, I hope this was helpful, guys. Please be careful out there. Just do your research, right? Know what you're putting your money into at the end of the day, so that you're making the best decision for you and your family, all right? I hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.